When should you use a debit spread strategy? Have you ever wondered when to use a debit spread strategy in options trading? This approach can be a smart choice for managing your risk while still aiming for profit. A debit spread is ideal when you have a moderately bullish or bearish outlook on a stock or underlying asset. It allows you to limit your risk while still having the potential for gains. So, what exactly is a debit spread? This strategy involves buying and selling to options of the same type, either calls or puts, with different strike prices. The option you buy has a higher premium than the one you sell, leading to a net cost or debit to open the position. When you initiate a debit spread, you pay a net premium upfront. This premium is the difference between what you pay for the long option and what you receive from selling the short option. The beauty of this strategy is that it limits both your potential losses and potential gains. Your maximum loss is capped at the net premium you paid, while your maximum profit is capped at the difference between the strike prices minus that net debit. Now, let's talk about when to use a debit call spread. This strategy is perfect when you expect the price of the underlying asset to rise moderately. If the asset price increases above the strike price of the long call option, you stand to profit. This method also limits your downside risk compared to simply buying a call option. The premium you pay is reduced by the premium you receive from selling the higher strike call. On the flip side, a debit put spread is what you want when you expect the price of the underlying asset to decline moderately. In this case, you buy a put option at a higher strike price and sell a put option at a lower strike price. This strategy allows you to profit from a drop in the asset's price while capping your losses. It's a great choice when you have a bearish outlook but want to limit your risk and reduce the cost of outright put buying. Keep in mind that debit spreads can benefit somewhat from an increase in implied volatility. However, since you are both buying and selling options, the effect is limited. Time decay generally works against debit spreads because you pay a net premium upfront. Timing is crucial since these strategies are directional. You want the underlying asset to move in the anticipated direction before expiration. Understanding the net premium paid is essential for calculating your maximum risk and potential reward. Debit spreads are particularly useful for traders who want defined risk and reward profiles. They offer a way to manage risk while still having the opportunity to profit from expected price movements in the stock and options markets. In summary, use a debit spread strategy when you have a moderate directional view on the underlying asset. This could be bullish for debit call spreads or bearish for debit put spreads. It allows you to limit your risk and cost compared to outright option purchases while still maintaining the potential for profit.